You have a viable business idea, you know people would buy it, and you've seen proof that it could work. But you are facing the same roadblock as almost every successful founder. You don't have the capital to execute. Money is the required fuel for growth, but the method you use to get that cash into your bank account determines how you have to run the company. Every funding source comes with a specific set of rules for your governance and a fixed trajectory for your future growth. This chart maps the central trade-off of startup funding, speed of growth versus founder control. In the top left, retaining total control limits you to slower growth restricted by personal resources. In the bottom right, pursuing massive scale requires surrendering significant control to outside entities. To get the cash you need, you have to choose which asset you are willing to trade away: your personal financial security, your monthly cash flow, or a percentage of your ownership. The specific money you take dictates the specific type of business you are forced to build. The first path is the solo route. Bootstrapping relies entirely on your personal savings and the revenue your business earns from day one. As the matrix shows, bootstrapping allows you to keep 100% of your equity. However, growth is bottlenecked by your own wallet, and you personally bear the financial loss if the business fails. Grants provide an alternative for founders who want capital without giving away equity or taking on debt. But as this row indicates, grants are far from free money. They require navigating highly competitive applications and mandate strict reporting on exactly how every dollar is spent. When you need cash but also need to prove your idea works, you move to the validation route. Raising money from friends and family is often the fastest way to get flexible early capital, usually based on personal trust rather than hard business metrics. This carries severe interpersonal risk. If the business fails, you may find yourself in significant debt to the people you care about most. Crowdfunding solves this by securing funds while proving customer demand exists. You get cash to build the product before ever going to a manufacturer. This method requires massive upfront effort in marketing and video storytelling. If the campaign fails to gain traction, that failure happens in the public eye. These early paths protect your equity, but they rely almost entirely on your personal hustle and existing relationships to reach any meaningful scale. If your business requires steady capital for physical assets, but you want to keep your equity, you may look towards traditional debt. Bank loans allow you to secure growth capital while maintaining 100% ownership of the company. Returning to the matrix, banks require collateral or steady cash flow to release funds. The trade-off? Fixed monthly payments drain your cash flow every 30 days, regardless of whether your business is succeeding or failing. While debt is an effective tool for predictable business models, it can act as a chokehold for experimental startups that haven't found their footing yet. For scalable tech companies with billion-dollar ambitions, the typical path involves trading equity for rapid expansion. Angel investors and accelerators exchange early cash for a small percentage of your equity, providing the mentorship and network access needed to avoid common mistakes. The immediate cost is that you now answer to outside voices, and you have sacrificed a share of all future profits. If you need to hire large teams and expand into global markets quickly, venture capital provides the heavy institutional capital required for that scale. As this final row shows, venture capital comes with high expectations for rapid returns. Because you traded away control, you lose the final say in major decisions. In extreme cases, founders can be legally fired from companies they started. Equity funding accelerates growth, but once you sell those shares, your company becomes an investor-driven machine rather than a personal project. The most effective funding strategy is built on alignment. You need to choose a capital source that matches your long-term vision for the company. This flowchart maps these options to specific business models, starting with a central question: what kind of business are you actually building? If you are building software, consulting, or digital services with low overhead, your best path is to retain your equity through bootstrapping. If you are developing a tangible consumer product that needs market validation before manufacturing, the ideal path is crowdfunding. If you are opening a physical storefront with a predictable cash flow model, you should pursue traditional bank loans. And if you are building an innovative tech platform aiming to scale rapidly and dominate a massive market, angel investors or venture capital provide the necessary leverage. Before you focus on how to get the money, define the daily reality and company culture you actually want to experience. Securing funding is just the starting line. Making the right choice is what secures the survival of the business. If this breakdown helped you, subscribe for more strategies on building smarter businesses.